Good morning, everyone. Welcome to Buffy 1026 Risk Management. How you guys doing? I hope you and your family are safe and you are coping well with the COVID-19, the new way of studying we are all experiencing. So my name is Thao Trang and I will be the lecturer of this course. You will be listening to my voice through 10 lecture recordings, which covers a topic of the course. I can say that derivative is one of my favorite course I have taught so far, and I hope that I can make you feel the same way at the end of the semester. We have the equity, the fixed income, the currency, commodity market. These markets are facilities for trading the basic assets of the economy, right? These markets exist around the world and receive so much attention in the financial and also the mainstream media. So they are not only familiar with the financial aspect, but also familiar to the general population. However, when we talk about the derivative, it is somewhat less familiar to the general population. Not many people have the idea what does that mean by derivative and how it can be used to trade and earn the money, right? Except for the financial aspect. So the purpose of this course is to introduce you the derivative market. Through week by week, we will explore many aspects of the derivatives and their use in depth. Okay, so that's the purpose of this course. So because this is the very first lectures, I will spend a little bit time on welcome and introduction of this course. First of all, I will introduce you the teaching team. Staff will involve with this course and have you throughout the semester. And then I will tell you what I think you need to know about the course in terms of the topic cover, what kind of assessment they're gonna be, what kind of resources you should make the most of, and how to succeed in this course. And after the short welcome and introduction, we will jump right into the topic one of this course. All right, so that is the introduction to derivatives. Okay, now let me introduce you a bit about the teaching team in this course. First of all, we have Dr. Kwan Wan. He will be the course coordinator for this course. So any general issue regarding the assessment or regarding the group assignment dispute or any accuracy of the marking, etc., you can contact Dr. Kwan. And I myself will prepare the recording and also have you with one tutorial. Let me introduce a bit about myself. So as I already mentioned, my name is Thao. You can just call me Thao. So I have a 6-year teaching experience in Australia and also overseas in a wide range of finance subjects. For example, I have taught corporate finance, fundamental of finance, money and capital market, risk management and derivative. My research specializes in the area of corporate finance, banking, and energy market. I hold a Master of International Finance at Deakin and also a PhD in Finance from Deakin University. Together with myself and Kwan, we have 4 tutors. We have with the other interactive workshop. We have Jung, Calvin, Hauzi, and Apana. So they are all experienced teaching staff at IMIT. So in this course, we will have a 2 week for the dueling training section. There are 3 staff will help you with the training section workshop. We got Jung, Dr. Galanos, and Dr. D. They are the workshop instructor. So anything regarding the dueling sections, just feel free to reach out to them. I guess your tutor will be your first contact if you have any either general or academic issue concerning the course. Okay, and the fastest way to contact us is to drop us an email. So just drop us an email. We will try to get back to you as soon as possible, if not during the weekend. So any email sent to us, please insert the course code Buffy 1026 at the start of the subject, because most of us will be coordinating and also teaching several subjects at the same time. So without a course code, we will not be able to identify which course you are from, and it will cause some inconvenience. All right. Okay, so the whole COVID-19 situation is challenging for all of us, right? I really appreciate your value and your effort, your patience that you are keeping up with your study at IMIT so far. So if you have any issue at all, if you need any support, don't hesitate to reach out, okay? And it is also important that during the semester, feel free to share your learning experience, give us any feedback you have. So if you provide us with any feedback along the way, we can improve the online learning and delivery together, and we will enjoy the ride together. Now let's talk about the delivery approach. What is the delivery approach of this course? In this semester, it is a bit different from the last semester. The course will be delivered under the blended learning model. What does that mean? It means that we will have the 90-minute pre-recorded lecture followed by 90-minute interactive section or tutorial class. Okay, so the recording lecture will be uploaded by Monday each week, and the tutorial solution will be posted after the last interactive section, which take place on Friday. So in summary, you will have the lecture recording available at the beginning of the week, and the tutorial solution of the previous topic will be available at the end of the week. Okay? So you are required to watch the lecture before you come into the tutorial section. So obviously the lecture slide adopted from the textbook. So most of the tutorial questions we discuss come from the textbook. I think it's very important to have a textbook because you can always learn a lot from reading, right? Textbook is a very good supporting material to the lecture, and obviously it will help you to understand the related content better and deeper. So the highly recommended textbook for this course is The Fundamental of Futures and Option Market by John Ho in 2016. Okay. Besides the lecture and tutorial, the main methods of communication will be through the announcement, email, and Canvas inbox. So please make sure you adjust the notification setting for email, Canvas, announcement on Canvas, so that you don't miss any important announcement from the teaching staff. And make sure that you regularly visit the Canvas page so that you will remain up to date with the course activities. Okay? There would be a lot of calculation in this course, so I advise you to obtain the calculator. So this calculator can be the financial calculator, it can be scientific calculator, so it's up to you. Okay, but use the one that you be familiar with and the one that you can use the most efficiently. Okay. We will have 1 week lag between the lecture and the tutorial. For example, the first tutorial will start from week 2, right? Let's say this week, week 1, we will have the lecture week 1, but the first tutorial will start from week 2. Okay, so the tutorial 1 will be conducted during week 2. It will discuss the question and the content related to topic 1 in week 1. So it means that you would have a sufficient time to listen to the recording, review the lecture slide, and work on the tutorial question on your own. And make sure you attempt to do the tutorial question before attending the interactive tutorial classes so that you can make the most out of the interactive time. Okay? If you attempt to do it beforehand, you will know which part you are struggle with, and during the interactive section, you can ask a question. Right? And now, how to succeed in this course? Just like all things in life, the harder you work, the better you get. This is not an exception, right? So to succeed in this course, you should go through all the teaching materials, mastering the tutorial question, reading the relevant content of the textbook, and completing all the assignment. Okay, so my advice is that you should start working on the assessment as soon as possible, rather than leaving it until the last minute. This is one of the most challenging courses I can say in the undergraduate program. So your study will be more effective if you devote some time on the regular basic rather than studying only in large time blocks. So don't leave it until the last few weeks and then start all of it. It is impossible to absorb the heavy knowledge just during the short period of time. Okay? Each lecture video, I will guide you through the new knowledge. I will show you the general picture and the connections between the different parts of the topic. So it will help you to remember longer and understand faster rather than just reading from the boring textbook. Okay? And then the interactive sections is where the tutor will do the summary of the main point. Will help you to practice with what you already learned during the lecture, help you to master every kind of the question. Okay, that's very helpful for your assessment. What if you have any question? If you have any question regarding the course, regarding the material or the assessments, feel free to post your question on the discussion forum on Canvas so that everyone can learn from your question and vice versa. Okay, and if you feel not comfortable to review your questions publicly, then feel free to drop the tutor an email or utilize the drop-in consultation. Okay, the consultation hours will be announced very soon. So in summary, this course has a very good balance between theory and calculations. After the course, you should develop a strong understanding of both the concept and the tool that will help you in the subsequent study and professional life. So I hope that you would understand the economic rationale under each calculation. All right, not just learn the calculation or apply the formula robotly. Okay, you need to understand the rationale behind each formulation. Understand what is the intuition behind the formula. That's the most important thing. Okay, we want you guys to do very well, so we will try to give you as much support and encouragement as we can. Okay. How about the assessment of the course? Assessment is divided into 3 parts. The first one is the midterm test conducted online. We also have the group assignment and individual assignment. Each assessment will account for 20%, 30%, and 50% respectively. Let's talk about the first one, the midterm online test. So your online test will be 50 minutes long, which will be released in week 6. The test will be open online on Canvas for 2 days from 16 to 17 April during week 6. Alright, the test consists of both MCQ and short answer questions. Each question will be worth 1 mark. Okay, and you got in total you got 20 marks for this assessment. So in this assessment, you will be tested your comprehension and your understanding of the topic covered in week 1 to week 4. Okay, so there will be 4 topics covered in this test. How about the second one, group assignment? So the group assignment, you are required to work in a group of 3 to 4 students. And when you form the group assignment, you should not switch to another group. Okay, it is expected that each student will contribute actively to the group work until it is completed. It is for your own benefit. So in this assignment, you will be asked to prepare a consulting report to a client. The report needs to address several issues or the case study or the scenario faced by the client mentioned in the questions. So how to find the group assignment, especially in the online environment? I know it can be challenging for you guys because some of you only register for the online class rather than the face-to-face. So we have a session name looking for the group member on the discussion board on Canvas. So I recommend you guys to actively look for the group member by posting your queries and introduce yourself in this section. Okay. So after the first few weeks, if you're still facing the problem forming the group, feel free to contact your tutors or the course coordinator, okay? And we will help you to form the group. The last assessment is the individual report, okay? The assessment will require you to play a role of the derivative analyst. So you asked to prepare a detailed report, to write a risk management report based on the scenario. You are required to apply the knowledge, the analytical and critical skill you have learned in this course to provide a written report based on the risk management scenario or the practical corporate or market scenario. Basically, this assessment is designed to test your understanding of the theoretical as well as the technical knowledge associated with quantifying risk, how to use the derivative product for hedging, and other related topics covered in the course. This individual assignment provides you the opportunity to work independently to facilitate self-improvement and it helps you to take the responsibility for the quality of your individual work. Okay, the detail of all the assignment or assessment will be available in due course. And the tutor will explain more in detail to help you to guide you with the assessment. Okay, let's move on to the syllabus or the teaching schedule of this course. The question you may be asking yourself when you start this course is that what knowledge you're gonna learn, what knowledge you're gonna gain when finishing this course, right? The knowledge you're going to learn is derivatives and risk management. That's it. So that is the key thing we will cover throughout this semester for this course. Basically, the course comprises of 8 different topics. Okay. So if you look at this syllabus, you can see that in topic 1 today, I will be introduce you the overview of all different kind of contract, all different kind of derivative product, some core concept used in the derivative market, and you will have the general impression about what are derivatives. Okay, in topic number 2, we look at the interest rate risk. This concept is very important because it will be instrumental for the further topic you're going to learn. In topic 3 and 4, we will focus on the future and forward market. Okay, so we look at the definition, the main characteristic, how the future different from forward, and what is the trading mechanics, how to price and evaluate the future and forward contract, and how to use the hedging strategy in order to manage risk exposure. Okay, that's what we're going to learn for topic 3 and 4. And then topic 5, we will break into 2 parts. We will study topic 5A during week 5. It's covered the interest rate swap. And then topic 5B, we cover during week 7. It is about the currency swap. Okay, but basically topic 5 is about the swaps. When it comes to the topic number 6, we will pay our attention to option, another type of derivatives. How option different from swap, from future and forward contract. We're going to learn about option, the definition about the unique characteristic, because option for me it is the most interesting instrument among the different type of derivative product, because option give the buyer the right, not the obligation. Okay, so it is quite distinct from other type of derivative. When you involve with the other type of derivative, you involve with the obligation. But when you buy the option, it gives you a right, not the obligation. Okay, so we will learn about that things during the topic number 6. And then if you look at topic number 7, you can see that it is quite different from other topic. We're not looking at any specific type of the derivative product, but it is quite closely related to other topic. So in this topic, you will learn how to quantify the market risk using the value at risk method. The market risk is the motivation for derivative to be used. So this topic will explore what is market risk and how to measure it using the different methodology. Okay. Then we have the final topic number 8, that is about the credit risk management. So what is the credit risk management? We're going to talk about the very special cases of derivative product, that is the credit CDS. Okay, so we look at the valuation of CDS, we look at the other type of the credit derivatives. So how the CDS is different from future, forward, or option. Other type of the derivative, it is the price of derivative is derived from the underlying asset. Right? There will be the transfer of the underlying asset from one party to another party. But for the credit derivative, it will be the different case. In case of the credit derivative, the price will derive from the credit risk of the underlying asset. Okay, so it will be the transfer of the credit risk from one party to another without transferring the underlying asset. Okay. So there are some things you need to bear in mind when we're looking at the syllabus. The first thing is that there is no tutorial during week 1. So it means that this week you will spend some self-studying time to review some knowledge, to refresh your mind about the time value of money concept. There is no lecture and tutorial in week 6 and 9. Okay, tutorial and lectures are replaced by dueling section, which will run by the dueling workshop instructor in week 6 and 9. So no lecture and no tutorial during week 6 and 9, but you will have the dueling workshop during week 6 and 9. Okay. It is very important to attend these workshops because it will link to your group assignment. And the last week in week 12, we don't have any new topic to learn. It's just we spend this week for the revision. If you're looking at this syllabus, it seems that derivative market can be overwhelming to study, right? Because there seems like such a lot of things to cover, and all of these things is new for most of you. But don't worry, everything is held together by a few fundamental principles. These fundamental principles, if you hold this principle, you understand this principle, it will help you to see through the picture, and you will find that it's not as complicated as you might think. Okay, this is a very interesting course to learn. I can guarantee that. And my job in this course is to guide you with the course material and make the complex concept and the jargon term easier to understand for you. Okay, so help you to see the general picture that connect between topic to topic so that you can understand faster and remember longer. Now let's jump right into topic number 1. So in this topic, I will introduce you to the different type of derivative, for example, option, forward, future contract. I will give you some examples so that you have the general idea, general impression about what does that mean by this derivative product. Okay, we talk about what are the defining characteristics of the derivative, how can we distinguish between derivative and equity and debt, what the main difference between them. What are the benefits of derivative? What are some criticism of the derivative? What the purposes do derivatives serve for the financial market participant? Okay, we look at the different type of the market participant and what is the role of each market participant in the financial market as well. Okay, so that kind sort of thing I'm going to discuss in the topic today. When you hear people speak about the trading or investing, most likely they will be talking about share trading. Share is one of the most popular or the most traditional ways to trade in the financial market, particularly among the individual investor. But when it comes to the derivative, not many people familiar with this concept, right? So do you have any idea about what are derivatives? What does that mean? Financial instruments may be categorized as the equity, debt, and derivatives. All right, 3 types of financial instrument. So, do you know how the derivative they are different from equity and debt? Why do the company want to issue equity and debt? And why do the company want to issue the derivative? All right. So, in order to function well, all the company they need to raise money. They need money to invest in their project. They need money to pay to the employee. They need money in order to expand the business, to buy equipment, etc., and to pay to the supplier, right? So how do they raise funds? The company can go to the bank to borrow money, or they can go to the financial market. If they choose to go to the financial market, then they have 2 options. They can issue shares or bond, right? If they issue share, then they need to pay the investor the dividend every period, every year, for example. Investor, they will get this share and they pay the money to the company. And if the company issue bond, then the investor will receive the coupon payment. They will receive the face value of the bond at the maturity. All right. So basically, the company they issue debt and equity to raise funds. That's the main purpose. How about the derivatives? Derivative is not used to raise funds, but the main purpose of derivative is to manage a particular risk exposure. Okay, it is used to hedge or reduce risk. All right. Derivative instruments they are different from equity and debt in that they do not provide the actual funds for the issuer, but they use to manage risk. Now let me show you the very simple example. Suppose that now we have 2 traders, trader A and B, and we will look at the perspective of trader A first. All right. So trader A, he would like to buy 1 million barrel of oil in 4 months from now. All right. He doesn't need this amount of oil now, but he need it only in 4 months from now. And the current oil price is $52 for 1 barrel. So for 1 million barrel of oil, it will cost trader A 52 million to buy it now, today. Okay. And he believes that in the future, the oil price will increase. It will be higher than this amount of money. Okay, so if he buy it now, he need to pay 52 million. And if he wait until 4 months from now, this will be more expensive for him. And he believed that. All right. What do you think? What would he do in this case? Let's say he has no idea about derivative. Then should he buy 1 million barrel of oil now, or should he wait and buy it in 4 months? What do you think? Alright, so let's talk about the first option. If he chooses to buy it now, then what happens? If he chooses to buy it now, it means that he needs to store 1 million barrel of oil in the warehouse, right? Because he doesn't need it now, he needs it in 4 months. So the storage cost for 4 months, it is not inexpensive. That is one kind of cost, if he chooses to do option 1. If he buy it now, he will need to pay 52 million right away, right? He needs to pay it today. This amount of capital can invest elsewhere to generate return for 4 months. If he can invest 52 million in the financial market, he can earn 5% return on this amount of money. So basically, there are two kinds of costs. These are the storage cost and the opportunity cost. The cost that the capital tied up cannot be invested elsewhere, right? If he chooses to buy now. How about another option? If he would like to wait and then buy in 4 months, he may pay more than 52 million, right? If the oil price increase as he expected. So there will be the risk of the oil price increase in the future. There are disadvantages for both options, option 1 and 2. This is where the derivative come in play. Let's say now A will come to B, okay, trader B, and A said, alright, how about now we sign a financial contract, and then in this contract, I will agree to pay you a fixed amount of money, 52 million in 4 months, and in 4 months, you will deliver 1 million barrel of oil to me. Okay, this only happened in 4 months, but now we will lock in the price at 52 million. How about that? In this way, A doesn't need to buy it now, right? A will only get the delivery in 4 months time, so there will no storage cost. And in this case, A doesn't need to pay $52 million now. He will only pay in 4 months. So he can invest this amount of money in 4 months elsewhere in the financial market, or he can simply put it in the bank, right? And in this case, he can also lock the price today at the $50 million for 1 million barrel of oil. He eliminates the risk of increasing in oil price in the future. And that's the benefit of the derivative. You may be wondering, how about B? Why would B want to enter to the financial contract? What will be his benefit? On the other side of this trade, there might be company B, that is the oil company, who will have oil to deliver in 4 months' time, but the company is concerned that the price will fall. Alright? And the company expects the price may drop to, let's say, only 50 billion. Today it is 52 million. Two traders, they have a different expectation about the direction that the price is gonna be. So A believe that the oil price will increase, but B will believe that the oil price will decrease. Okay, and when they enter to the contract, they will lock in the price today. Basically the future contract satisfies the need of both traders. And this is the typical example of the future contract. The future contract is one kind of the derivative. All right. So you can see that derivative, it is the form of the legal contract. It is the financial contract. It will involve two parties, okay, two sides of the trade, the buyer and the seller. So the buyer who agreed to buy in the future at the fixed price today is so-called the long, okay? Or we can say trader A long the future contract. This means that you're gonna buy something in the future at the price fixed today, and from the B perspective, he will agree to sell something at some day in the future at the fixed price today. Therefore, he is so-called the short, or he short the future contract. Another characteristic of derivative contract is that, as the name suggests, derivative is come from the term derive. So derivative, it is the financial instrument whose value depends or derive from not the value of itself, but the value of another asset. Okay, and this asset is so-called underlying asset. If the price go up, then who's gonna benefit from the financial contract? Who's gonna benefit from this future contract? A or B? If the price goes up, if the oil price increases, then the value of A position will increase. Why? Because let's say now the oil price in 4 months is will increase to 54, but in the contract A agreed to pay me a fixed price at 52. He locked in the price at 52. So it means that he paid cheaper than he's supposed to. How about the trader B? Trader B will incur losses because he would have sold 1 million barrels of oil at 54 million in 4 months, but now, as he already promised, he only received 52 million. So the loss or the gain of each trader in the future contract, it depends on where the price actually be in 4 months from now. Okay? So if you look at this example, you can see that the underlying asset for this future contract is oil. Okay, oil is the underlying asset in this example. So the asset used to trade derivative is so-called the underlying. It can be the real asset. You can write the future contract on another kind of commodity, metals, or another sources of the energy, etc. Right? Or you can also write the financial contract on the financial asset like equity indexes, like share, the cryptocurrencies, etc. All right. So the asset, the underlying asset, it can be the real asset or it can also be the financial asset. Now we look at some terminology. So derivative is the financial instrument that be written based on the underlying asset. Okay. So underlying asset, for example, the stock, indexes, or the interest rate, or the debt instrument, electricity, etc. They are traded on the spot market. Okay. The market where the underlying asset are traded is so-called spot market or cash market. And the price of the asset is so-called spot price. So if the underlying asset is a stock, we have the stock price, right? If the underlying assets are bonds, you will have the bond price. But all of these price, the common name for all of these price is so-called spot price. Okay, the price of the underlying asset in the spot market is so-called spot price. How about derivative? On the other side, we got derivative. So derivative will be traded on the derivative market. Okay, and the price of the derivative also have another name. If the derivative is future contract, then you got the future price. If it is the forward, then you got forward price. If it is option, then you will have the exercise or strike price. Okay, and if you have the swap, then you will have the swap price or the fixed rate. Okay, that are some terminology we're gonna use a lot in this course. We already gone through the very typical example of the future contract, one type of the derivative, and now you should understand the definition about the main characteristic of derivative. Now, next question is how derivatives are traded. As you likely know, for the share or equities, they are traded on two markets, organized exchange or in the over-counter market, OTC market, right? There are two markets for equity, organized exchange. For example, we got the Tokyo Stock Exchange, New York Stock Exchange, or ASX. That in case of Australia, Australian Stock Exchange, or in the over-counter market. So similarly, the derivative also have two markets for them to be traded, OTC market and exchanges. Basically, at one time, the major difference between OTC and the exchange market is that the exchange market, they will brought the buyers and the seller together in a physical location. But for the OTC market, they will facilitate the trading strictly in the electronic manner. But today, these distinctions are very blurred because many organized exchange, they have gone completely to the electronic system. Although the distinction between them become less and less nowadays, but there are clear differences that are very important to understand. Alright, so we talk about the OTC market first. The OTC market, it is largely unregulated. all right? And very high level of privacy. This means that I would like to write the future contract. I can come to the OTC market and you and we can sign the future contract. So we can do this privately without anybody being aware of the term of the contract, including the price or the settlement date, etc. Right? The products such as swaps, forward contract, the options are mostly traded this way. In the OTC market, there are fewer restrictions and regulation on trades. The participants, they have more freedom to negotiate the deals. So we can see the OTC derivative, they are custom-made. It means that custom-made means that you can design the contract the way you want. So the advantage of the OTC market is that it have a higher privacy compared to the exchange, because in the exchange market, when you trade in the exchange market, the participants are required to disclose all the information of the trade. But what are the disadvantages of the OTC market? Because it have a higher privacy, right? It less transparency. It will have the higher level of credit risk associated with each OTC trade. It's less regulated. Credit risk will be higher. It means that there's higher chance that one party will default on the contract. Of course, because the exchange traded derivatives, they are standardized, whereas the OTC derivative, they are customized. Therefore, the exchange market will offer the higher liquidity. The standardization of the contract will facilitate the creation of more liquid market for derivative. That's the main difference between the exchange market and the OTC market. Okay, OTC market, less regulation, higher privacy, less transparency, higher credit risk. Exchange market, it will be standardized. It is the higher liquid market for derivatives and more transparency. All right, and lower credit risk. What is the size of derivatives? Is that big enough to justify our study of derivatives? In case if you think that the derivative market is not large enough to justify studying, we should consider how big the market is. Alright, look at this figure. You can see this is the outstanding OTC derivative, the size of the OTC market. The OTC market, it is the largest market for derivative. It is much larger compared to the exchange market. However, it is not simple to measure the size of the OTC derivative market because, as I already said, OTC derivative contract, they are the private transaction and not much information disclosed from the OTC trade. Okay, come back to this figure. You can see that there are three lines, red, blue, and yellow. For now, you can ignore the yellow line, alright? So the red line, it is the notional amount. And the blue line, it is the market value of the OTC trades. What are these variables? Notional principal and market value, they are the two main measures of the size of the OTC market. For example, if you go to the swap dealer and enter into the swap to hedge around 50 million loan, the interest rate will be calculated based on this 50 million, and it is so-called the notional amount. Okay, the notional amount of 50 million is written clearly in the contract, stated in the unit of the currency on which the payment are calculated. Forwards, swap, and OTC option, they all have the notional principal, so they can be measured in that manner. Notional amount is very accurate measure because it's written on the contract clearly, right? It agreed by both parties. However, it does not accurately reflect the amount of money at risk. That is the amount of actual money under exposure. Alright? The money under the exposure is better indicated by the market value. Market value, however, must be estimated. Therefore, it will be subjected to error. For example, you and I are the both trader of the contract, right? So we can disagree on the market value of the same transaction because we have different methods to estimate the market value. Imagine that it is very similar to when you buy a house. The price listed is similar to notional amount. It is clearly listed, quoted in the market, right? But different buyer, they will have the different estimation about the market value of the house, about how much the house is actually worth for them. Okay, so market value, it is estimated and may be subject to error. Notional amount is more accurate because it is clearly written and it is agreed by both parties, but notional amount, it overstates the amount of money actually at risk. On the other hand, market value, although it needs the estimation, but it provides more meaningful measure of the amount at risk. If you look at the graph, you can see that the market value figure will always be well below the notional amount. You can see that the blue line is well below the red line. At the end of the 2018, the notional amount of global OTC derivative was more than 500 trillion and the market value was only about 10 trillion. Right? So which one is more realistic? A figure of 500 trillion is almost a misleading measure of the amount of money at risk. And the market value figure of 10 trillion is much more realistic, but it is less accurate because it relies on the estimate provided by the bank. And after the GFC 2007 and 2009, the size of the OTC market reduced sharply. This is because the OTC market has been highly regulated since then. Therefore, the transaction and the size of the OTC market reduced sufficiently. But we can see the size of the market is still big enough to justify the study of the derivative market in this course.